So my name is Amit Bhatti. I'm the U.S. counsel here at 500 Startups. Just a little bit of background. So what I do at 500 is I look over the legal end of all of our investments from our main global funds, especially all of our investments in the U.S. Before joining 500, I was at Wilson Sonsini, which is a law firm based in the Bay Area, and primarily focused on venture capital financings and representing anything from a small startup all the way up to companies gearing up for IPOs. So today we're going to be focusing specifically on convertible securities. And as Newton mentioned, this is just going to be an intro to the type of content that would be at the Berkeley program. Obviously much more simplified for the quick format we have this morning. So jumping into what we're going to be discussing, as I mentioned, we're going to be focusing on convertible securities, though that is only one piece of what typical venture financing deals look like. Broadly, it can be separated into two buckets. Deals made on convertible securities, such as convertible debt or convertible equity, or preferred stock financings, which are more formal rounds like a Series A, Series B, where you would be investing and purchasing shares directly from the company as opposed to a note or a safe. So let's talk about convertible securities as a whole bucket and why you would want to use them. So primarily, convertible securities are used by early stage companies. Sometimes they're used as a bridge between a Series A or Series B or another preferred stock round, but primarily they're used by early stage companies. And there's a couple reasons for this. So one would be that there's no fixed valuation of the company when you do a convertible security. So there's no price per share. There's no negotiations around valuing a business that's very early on. That is helpful because that's one of the big negotiation points in closing a preferred stock financing. Because it has so many fewer terms, there's much less negotiations required. So these deals can happen much more rapidly than a Series A financing would happen. Because of that, there's not often a term sheet. So often a company will put together a note or a safe or a KISS and go around and fundraise just with that rather than having a term sheet. So really, it's helpful as an investor to be familiar with the terms that are in these documents because you're not going to have the opportunity to go through a term sheet and have some back and forth there. As well as being fewer terms, there's also usually very light due diligence done for convertible securities, which also helps with the speed of these transactions. The deals are often done on a rolling basis, which means that if you're investing, you can come in today and a new investor can come in a month later, 2 months later on the same terms. Whereas with a Series A or Series B, typically all the investors will come in groups, maybe as one closing and have a specific time window for the entire fundraise to happen. Also, something that's common across all types of convertible securities is that the two most common methods to convert the convertible security into equity is a discount or a valuation cap. And those terms will be important because we're going to go through an example of how to convert any type of convertible security into equity at the end of this presentation. So going into one of the types of convertible securities first, we're gonna talk about convertible debt, or some people might just call these convertible notes. For a long time, this was the only type of convertible security people would use, and they're still very commonly used. The form this ends up taking is a convertible promissory note. So that would be the actual document that you would sign on to as an investor. And this is important because a promissory note actually is meant to be repaid. That's in the terms of the document. It never actually happens in practice. No one actually wants to be repaid, but the language of the document actually talks about repayment. So the two ways a convertible note can end is that it can be repaid or it can be converted into equity. Usually that conversion to equity happens at the next preferred stock financing that the company does. And at that point, the note would automatically convert. So that note always has an interest rate and maturity date. It's part of the document. It always has to be there. The maturity date is often extended because, as you know, companies are having longer and longer windows from their first kind of friends and family convertible rounds, and angel investors, all the way to a Series A. The time window between those two rounds happening has been getting longer and longer. So you might enter into a convertible note that says, it has a 2-year maturity, but now it can take companies 3-4 years to reach that Series A level. So what that means is if you have a convertible note, you always have to keep an eye on when it's coming matured and whether or not you want to extend that maturity and give the company additional time. In practice, most savvy investors will always extend the note because there's no gain to having your money repaid with a nominal amount of interest. Really the upside on investing on a convertible note is on the conversion to equity and eventually having valuable shares in a growing business. So the maturity date ends up being really unimportant, but it's always in these documents. So that's actually one of the downsides of using a convertible note, is having to have that maturity date and constantly having to keep an eye on that maturity. Another potential downside of convertible notes is that because it actually is a debt that is legally required to be repaid, it has the potential for insolvency issues for the companies. If a company issues $1 million worth of convertible notes, often these are small companies, they're not profitable, and if they have some issue where they need to pay out or buy back shares under Delaware statutory law, they're not always able to do that if they're insolvent, which they would be with such a large number of debt outstanding. In practice, this doesn't always come up, but it is something to be considered by companies when they're using convertible notes. They're also unsecured for investors that are used to loans that are backed by some form of collateral. There's almost never any kind of security interest in connection with a convertible note. So one tip, and throughout this presentation, there's on these slides, you'll see investor tips or kind of hints for savvy investors. And this is another thing we'll talk about during the program is things that are best practices for investors. So the first one here is it's always good to clarify what happens to that debt if the company is acquired before that note converts. And that's important for a couple of reasons. Because it's a promissory note to be repaid, if there was no clarification in the document as to what would happen, say you invested $100,000 and the company gets acquired for $50 million, it could be that they just pay you back that note. So you really want to clarify that if the company is acquired, that there could be a premium, a 2 or 3x payment on your note. So it's important to kind of think about all of the potential outcomes when you're investing on this type of document. So the next form of convertible security we're going to talk about is convertible equity. Now, the convertible equity documents have become much, much more common over the past few years. 5-6 years ago, these would be pretty unusual, and not very many people outside of Silicon Valley would have ever even heard of them. But now they've become much, much more common in many markets, even across the world. So the two most common forms of convertible equity are the SAFE, which was a document developed by Y Combinator, and the KISS, which is the document that we at 500 Startups use most often. And these are essentially a similar document. They're just a different name for a type of form of convertible equity. It's just a convertible security by another name. So These also convert to shares at the next priced financing round, but there's not usually a term for specific repayment. So that gets rid of one of the issues that we talked about with convertible debt. So because there's no repayment, there's no maturity date required generally. There's no need to extend or amend the agreement over and over again to allow for more time for the company to reach that conversion. And because there's no repayment, there's no insolvency issues as well. Also, you have the ability to take out the interest rate. So that reduces one more of the negotiation points that you might have when doing convertible security. So the tip here is that these forms are often available on the internet, and they come in a lot of different flavors. So there's the bare bones terms of actual conversion into equity, and often there's additional rights that can be granted. So you want to be really careful when you're reviewing a SAFE or a KISS from the investor perspective to see what rights that you're getting in the document, and to know that there are additional rights you could ask for or negotiate for, even using a convertible note. So, some of the most common you might see is something called a most favored nation clause, which would be a clause that gives you as the investor the right to get the best deal possible that the company has offered to anyone else. So say you invest $100,000 today on, a 20% discount, and 3 months from now, the company issues another note with, a 30% discount. If you have a most favored nation clause, then you would have the right to have your note also get that preferential discount term. Another term you could get is pro rata rights to participate in future financings, or information rights to kind of stay in the know about the company's financial status. So today, because we have a limited amount of time, we're going to focus on just a couple key terms of the actual conversion of convertible securities into equity. At Deal Camp, for those that have attended or for those that will attend, you'll see that we'll go through kind of all the terms of convertible securities and preferred stock financings in much more detail. But today we're going to focus specifically on how these securities convert into equity. So to do that, there's a couple key terms to think about. The first being the discount. The discount is as straightforward as it could get. It's just a percentage discount applied to the price per share of the preferred stock round when your convertible security converts into equity. So the most common range for the discount is between 10 and 30%. This can vary based on how strong the company is, what market you're in. In Silicon Valley, it might be common for it to be 20%. In another market where there's less availability of capital or less companies and more investors, those percentages could skew one way or the other. The more complicated term for conversions is the valuation cap. So a lot of people get confused and think that a valuation cap is the valuation of the company, but it's actually not a valuation of the company at the time you're making the convertible security investment. It's actually the maximum pre-money valuation that can be used to calculate the conversion price. So what that means is if I'm investing in a startup now and I'm offering them a valuation cap of 5 million, I'm saying that my initial investment can't convert at a valuation higher than 5 million. That's the maximum valuation that it can convert at. So it gives you some sense of protection that if the company's next valuation is so high that your small investment won't essentially be diluted past a certain point. So we'll go through examples of each of these conversions in just a minute here, which should lay this out a little more clearly. The third piece or a key term to think about is the capitalization. So this is just one more function of the actual economics and calculations. What it means is is the amount of company shares that are issued and outstanding. So to calculate the share price in a round, you normally take the valuation of a company and divide it by the capitalization. So when you're using a valuation cap, you have to have a clear definition of capitalization so that you can actually calculate the conversion price at that time. And we'll go through in an example to make this clearer. The tip here is that you should always make clear in your convertible note, SAFE, or KISS what the full definition of capitalization will be. It's important to make clear that you should always include any increase to the option pool, any other convertibles that will be outstanding at the time of conversion, or any warrants should be counted in that capitalization. And that's because often when a financing round is done, companies will increase their option pool so they have equity to give to all the new employees they're going to hire with all this great new money that they've raised. But if you as an investor don't count that option pool in the capitalization before you put your money in, you're immediately getting diluted by that option pool increase. So a smart investor should always make sure that that amount is clearly being counted in the capitalization before the round takes place. And so one other topic I wanted to throw out there, just as a thought point for everyone on this webinar, is conversions are all based on the next financing round that the company does. Over the past year, many more companies have been going a different route and raising money through an ICO. And an ICO, for those that don't know, is an initial coin offering. So that means that they're converting some sort of, or they're releasing some sort of token or security and raising money that way without actually doing a preferred stock financing. So for all of the traditional convertible notes or SAFEs or KISSes that you have out there, there's really no mechanism for that to convert at an ICO. So it's important for everyone investing now, and especially with companies that may go this route, to think about how you would want that convertible security to be treated if the company raises their money outside of the traditional ways that's been done in the past. So this is a topic that we'll touch on more at Berkeley, but definitely a continually evolving part of the practice. So let's go into the first example here of how an actual conversion would happen. So staying on the ICO and cryptocurrency theme, say you found this hot new company, it's called Cryptocurrency Incorporated, and you've decided you want to invest $200,000 on a KISS note. So your key economic terms that you've decided on are that there's going to be a $5 million valuation cap or a 20% discount. So you can see you've made that investment on a note, and then several years later, Series A term sheet comes in, and the valuation that the new investor has placed is $4 million is the valuation of the company. And for example, we're saying that the company has 2 million shares outstanding. So the real simple calculation of price per share is that 4 million pre-money valuation gets divided by the 2 million shares outstanding, and you end up with a $2 price per share. So in this case, we're just going to use the discount. So then we multiply that $2 price per share by 80 cents. Or by 80%. So you get your 20% discount. You end up with $1.60 per share. So your initial $200,000 investment gets divided by that price per share rather than $2, and you end up with 125,000 Series A shares. So you get 25,000 extra shares because you entered as an early investor and you have this 20% discount. But we'll see right here how the valuation cap can significantly change the amount of shares you end up with and the discount that you actually receive. So we're taking the same initial investment of 200,000 with $5 million valuation cap and a 20% discount. And this time we're saying that the Series A term sheet came in with an $8 million pre-money valuation. So here we're keeping the same amount of shares outstanding is 2 million. This time the price per share comes in at $4. So if we just use the discount, 80% of $4 ends up at $3.20 a share. If you use the valuation cap instead, because the valuation of the Series A round is higher than the valuation cap, you can actually recalculate the entire price just for your specific note. So what happened is we use a $5 million pre-money valuation rather than an $8 million pre-money valuation, divide by the same amount of shares outstanding, and we get a $2.50 price per share. So when we carry that out to our actual investment, our $200,000 investment then gets divided by $2.50, and we end up with 80,000 shares. This ends up being almost a 40% discount to the full $4 price per share that the new investor is paying. So you really want to be careful where you set your valuation cap, and make sure that when you are investing on convertible notes that you're paying attention to how they're being converted. It's not uncommon for people to misunderstand the terms or to not follow up exactly on how the conversion is being done. And typically when you're signing up to the documents of the conversion, you're signing up that the conversion is correct. So it's really, really important to understand these key economic terms of convertible securities and making sure that you understand how they should actually turn out. So one other thing to think about that's actually come up recently is the concept of shadow series. So because convertible notes convert at this discount or valuation cap, that means that the investors using these are not paying the same amount for shares that new investors paying the full $4 per share, for example, in the last example, paid. So that means that the company and the new investors are sitting there thinking, well, these people invested $200,000, but they're actually getting way more liquidation preference than anybody else who invested in this new round. So typically a company wants only the liquidation preference that the actual dollars that were put in. And this applies to convertible notes, convertible safes, or a KISS note. So we'll go through an example showing how this works. The same numbers from before. We've invested $200,000 on a KISS, $5 million valuation cap, 20% discount. We're going to show the example with the higher pre-money valuation and the fully diluted capitalization that we showed before of 2 million. Again, you see that the $8 million pre-money valuation gets divided by the 2 million shares. You end up with a $4 price per share. Running the math all the way through to the full 80,000 shares, we can see that 80,000 shares times the $4 price per share means that we would get $320,000 of liquidation preference. But our initial investment was only $200,000. So the company is thinking, this is liquidation preference is meant as a downside protection for investors. And so they don't want investors to be able to take more money off the table than they actually put in case of, a liquidation of the company. So the solution that is now very common is to issue shares of Series A and Series A-1 and A-2, A-3 for all the different convertible notes that might exist for the company. And the only difference between these Series A-1 and A-2 shares is that they will have different liquidation preferences corresponding to the actual price per share that they paid when they converted. So when you see a cap table now where a company has several different classes of shares all delineated by Series A-1, A-2, A-3, this is actually very common now, and it's not at first people thought that there might be some kind of tricks going on, but it definitely is very common and accepted practice to give people a shadow series of shares with correspondingly lower liquidation preference. So the last thing we're going to mention today is what happens in a preferred stock financing. So this is really the key to how a convertible a convertible note eventually turns into equity. And at the actual deal camp, we're going to go through all of the different terms of preferred stock financing as well. But the key thing to understand is there are many, many more terms and involved in a preferred stock financing. And so a term sheet becomes very key. Often that gets negotiated directly between the investor and the company, sometimes without even having legal counsel involved. And it's important to really understand the terms that you're negotiating, because it will be really hard to renegotiate a term sheet once it's been signed. You know, it's embarrassing to have to go back and say, oh, I didn't understand this term, I actually wanted this. It's hard to say, well, hey, we already agreed to this, and you end up losing some of your negotiating capital if you want to change things that were agreed in the term sheet. So at Deal Camp, we're going to be going through all of the big important things that investors should really pay attention to when negotiating a term sheet, and kind of lay out, here's some terms that your lawyer will handle for you. Here's some terms that are really important to understand. On the side of the screen here, I've listed kind of the difference of, you can see just in how much paper is involved in a preferred stock financing. For a convertible note or SAFE or KISS, it's just normally one document with a couple pages. For a preferred stock financing, you end up with several hundred pages of documents, because you'll have to amend the company's certificate of incorporation, have a stock purchase agreement. Typically in the US, you'll have an investor rights agreement, a right of first refusal, voting agreement. You could have side letters with additional rights. You have all kinds of other things. But ultimately, the best way to think about any type of investment in a startup is that there's really two considerations you should have, is the economics and the control. So economics being things like the pricing, the valuation cap, the discount that you're negotiating for, and the control being all of those other rights that we just briefly touched on, and really become much more important during preferred stock financing. So things like a most favored nation clause, or pro rata rights to continue invest in the company, or potentially board seats, or any other kind of control. So I know we went through really quickly today, but I wanted to make sure that we had a lot of time for questions, because, you know, these are just the basics, but you know, there's a lot more nuance we can get into, and hopefully we'll see you at the program to discuss in person.